Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. A lot has been going on here in a very short amount of time, so I'll do my best to describe it and what it may mean. I've often mentioned here how the bright green highlighted August 2022 to date uptrend, currently at 1920, how it did not act so much as a support or a resistance, but more as a nuisance. 9 weeks ago, this broken and now seemingly repaired bright green uptrend, along with the short medium moving average, currently at 1933, managed to erode the bullish incentive enough that they allowed a small bearish downtrend over July to late August. It was back then that I opined we might be undergoing a change of heart when I said in talking about the market, and I quote, "For the moment we are still exhibiting lower highs, a keen bearish sign, but the lower lows have sort of petered out and we seem to have some support at and just under the 21st century absolute Fibonacci line at 1809. And that would be the 50% absolute Fibonacci line. This support has been tested on and off since mid-May, and the room for maneuver is now so tight that either the support will have to break or the upper time." And that's the end of the quote. We then had a changeover gap move higher 5 weeks ago over the short medium moving average as well as the medium moving average. That's currently at 1924, and the broken bright green uptrend. The initial rise was just short of the March 2023 low at 2004, where we'd seen rejection there weeks before, which to be honest looked at the time like long liquidation ahead of the long weekend in the US. However, after this it looked more like a small resurgence in the bearish incentive, though in the end it was not excessive. Now, I did put out there some 9 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern looked for a while that it did not complete or even giving a clue as to the direction of its validity. And I've stated over recent weeks that we would need to see how the actions develop over the next few weeks. Now, I've stood by this point for a few weeks now, being very clear in the wording I used when I said on this point 9 weeks ago, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." And that's the end of the quote. This did not take away from the far smaller August-based double bottom, which saw its topside fulfilled during late August and early September. So, the rally started from mid-August, and over the mid-August to mid-September, the market formed a bullish halfway hesitation. 2 weeks ago, explosively reaching the topside target for this pattern at about 21 even, and triggering the previously mentioned double bottom pattern, the larger one. This had a topside target in the 2340 area, which was reached last week. In the process of rise, the market also created the opportunity for two quite large patterns, or should I say, one final pattern that may come from two possible developments. You see, the action since roughly January to February this year till now has set up the opportunity to be either a bump and run reversal pattern, typically a bullish pattern, but it is prone to throwbacks back down, or a descending scallop pattern, a pattern that could be seen as either bullish or bearish on a larger scale, and very much depends on what the market does now between last week's high and the low in September, at least. If it stabilizes, then prices could head significantly higher. If not, then significantly lower. These are big patterns. But these patterns are not fully formed, and they are formed enough for me to categorize the actions this year as being one or other of these. Of course, further patterns could develop in the meantime. There are three other features I would like to discuss. Firstly, the golden cross of the short medium moving average up over the medium moving average last week. This is a lagging indicator, but nevertheless an indicator. Secondly, the gap at the top of the market last week is the teeniest of gaps between 23.23 to 23.22, but it is a gap and is at the top of the market, which makes me automatically suspicious of the top side, just in case. We shall see if this is filled in over the next week or so. Finally, the and possibly most importantly is the possible and arguable bow tie formation made around the 16th of September of the short, medium and medium moving averages. Now this is not a clean bow tie formation, not by any means. And moving averages came in and exited out of the bow tie in the wrong order. But there is possibly a case for such a formation, especially as all have headed in the direction of the upward market. No surprise there really. All I can add is to watch out for volatility in the future between 15 to 20 sessions afterwards. That's typical for a bow tie. 15 to 20 sessions afterwards, so that is roughly between the 7th to the 14th of October. And at this point, I think I will leave it at that. Ice Europe white sugar in London. Many weeks ago I drew a start of April to start of July bearish Andrews pitchfork, which I since finessed to a bearish shift pitchfork, which provided the recent bearish angle of attack of the market. When looking at the action over recent months, I wish to emphasize some significant points. First off, the monthly key reversal down in July, which aided the move lower until mid to late August. The move lower was interestingly limited by the same bearish shift pitchfork. I also noted some 7 weeks ago a new pattern within a pattern like a Russian doll. This new pattern was the bright red bear channel you can see highlighted on my daily chart. At a turn of 6 weeks into 5 weeks ago, prices punched up through the top of this bear channel, giving some opportunities on the top side. A primary target X in the 560.90 area was achieved 2 weeks ago. I'd laid all this out beforehand, by the way, with a secondary hard to reach target X1 up in the 599 even area achieved last week. The move higher to achieve these targets was caused by the construction of a mid-August to mid-September bullish halfway hesitation, with an integral horn bottom that finally broke up through the upper tine of the bearish shift pitchfork, also achieving its own target up in the 576.5 area 2 weeks ago. The action over the last 2 weeks has possibly forced yet another pattern and resurrected an old one. The new pattern is a possible lopsided island pattern, with 2 gaps seen last week and the week before. It is, listen, I'm the first one to say it is not a great looking pattern, not by a long chalk. For starters, the gaps don't line up properly. But it is out there, and I'll be watching to see whether the action this week justifies it. It is by its nature a bearish pattern, but the opportunity for downside is limited. Perhaps where the flatlining medium moving average is currently at 546.90. I note especially the capping action of the slowly declining gold long moving average right now. That's currently at 583.80. Now the resurrected older pattern is the late December 2023 to mid-April 2024 descending triangle. This pattern showed its worth back in April through to early August when the market broke down through the base relatively early on and reached eventually both primary and secondary targets below. I've once again highlighted this pattern to show you in dark blue, as the market reaches the apex of this descending triangle this week in the 605 area. And you can easily see that it capped prices last week, along with some congestion from 2016. All this is rejuvenating the bearish pressures after a reasonable run upwards. I will thus keep a wary eye below, as we have a couple of fairly free areas. One we are in now, until the February 2017 high at 565 even, and then down to the 550.20 to 546.90 congestion, with the March 2017 high at 548.70 and the previously mentioned medium moving average. Anything of note beyond that, we'll have to look again. Sugar white premium. 22 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there. Between mid-July to mid-September, the market had been testing the lows of early to mid-October last year, down in the 115.75 to 116 even zone. I also noted many times that though we had been held up in that region for a while, this support may not have been as strong as seen back in October 2023. And this has proved to be the case. 3 weeks ago, I highlighted how the market made a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern, punching down through the 115 and 3/4 and 116 even zone, and down through the next congestion zone made up of the lesser Fibonacci lines at 107 and 3/4 and 104 and a half, to new lows not seen since February 2023. I said about the supports below 3 weeks ago, and I quote, "There are lesser Fibonacci lines further down at 107 and 3/4 and 104 and a half, but I'm not sure how good these are. The next support of note would be the lows of the first week of February 2023 at 83 even, the mid-February low 83 and 3/4 and the early February low at 81 and 3/4, end of quote. I continued further, and it is an important piece I dealt with, and I quote, "The only other feature to consider is a new one I've drawn on my weekly chart. This is not as yet established, but which deserves consideration. It is an April to date descending wedge pattern, currently 93 even to 130 and a quarter. This is still a nascent pattern, but one worth watching," end of quote. 2 weeks ago, prices breached and closed below this pattern. I've highlighted it in dark blue on my daily chart. It was no longer a nascent pattern, but the main pattern for this market now. I added 2 weeks ago, and I quote, "The key feature to watch for, apart from the obvious breakout of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top. That's currently at 76 and 3/4. This will be approximately during the week ending the 22nd of November this year," end of quote. Well, we have seen last week and this week the effects of this purple neckline. We didn't have to wait till the end of November, as it held the prices up last week and is barely doing so right now, this week. So what have we in the way of opportunities and barriers on the downside? I'll try and keep it simple and short, as the much larger picture has even me somewhat scared. For an immediate support below, look to the November 2021 low at 68 even, and then a congestion zone between 55 even down to 45 even, dating from July to September 2021. Now, in the bigger picture, we have to look at opportunities presented by the break below the descending wedge pattern. A primary target X would be in the 65 and a quarter zone, just below the November 2021 low, and is doable. However, the secondary, harder. Believe me, much harder to reach target X1. Well, that will be down in the 1 zone. Yes, 1 even. And this has gotten me somewhat scared, as this is below what I know to be prior lows, notably my 2009 low at 22 and a quarter. All this is without even considering the implications that just possibly the move lower may have triggered targets, finally, for the huge 2022 to 2023 diamond top pattern. And on that, I shudder at the thought of it.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.